Welcome to Inside India. I'm JP Ong, and here are your headlines. India strikes a careful balancing act at the BRICS virtual summit. Foreign Minister S. Jaishankar attending in Modi's place, calling for fair and transparent economic practices among the group. New Delhi is also cementing its trade ties elsewhere, inking a bilateral investment deal with Israel and a potential trade agreement with Qatar in the works. India's Auto Dealers Association expects the government's GST cuts to bring festive cheer next month. Good morning, and we start off once again, as usual, by looking at how Asian markets are setting the stage for us this Tuesday morning. Across the major equity markets, it's looking fairly cheerful for the most part. Once again, the Nikkei 225 up by about 0.5%, and earlier on today just crossed 44,000 for the first time in history, touching and testing another all-time high. It's a bit shaky, though, when you look across the mainland Chinese markets. Well, it was earlier on ago. The Shanghai Composite did open in the red, but has now managed to claw back and pare back some of those losses and is now marginally in the green. A bit more confident for the Hang Seng, up by about 1.3%, while we're all seeing the South Korean Kospi trading about 1% in the green. The ASX 200, though, one of the notable laggards today, down by about 0.7%. And the Indian markets also come online in about 45 minutes. And here's what Nifty futures are foreshadowing for us. We're seeing that it is looking like another day of gains for the Nifty 50. It seems that it's also trading about almost 200 points higher than Tuesday's close. The Indian rupee is coming off a day of strength, actually, but is now weakened once again, softened to about 87.95 or 96 against the U.S. dollar. Still off of those record weak lows that it has been testing over the last couple of weeks. And so far, just a little bit firmer, at least for the rupee, which is trading on firmer ground. Now, Chinese President Xi Jinping addressing the BRICS group of nations, stressing the need for unity in the face of the global tariff pressure. Elaine Yu joins us now and has more. Elaine, it's another day where we're seeing the BRICS heavyweights talking amongst each other. What is the latest with regards to what President Xi Jinping of China had to say to some of his counterparts in the BRICS group?
Right, so this is an emergency virtual summit that Brazil convened in response to escalating U.S. tariffs. And indeed, BRICS nations are facing very high U.S. tariffs. India, Brazil are looking at about 50%, and China is staring down more than 40% of U.S. tariffs on average. And Xi had some pretty pointed criticism when it comes to the trade war. He said the trade war waged by some country has severely disrupted the global economy, and he also called on BRICS countries to as standing at the forefront of the global south and to jointly defend the multilateral trading system. So let's take a listen at what he said at the summit.
Economic globalization is an irresistible trend of history. Countries cannot thrive without an international environment of open cooperation, and no country can afford to retreat into self-imposed isolation. No matter how the international landscape may evolve, we must stay committed to building an open global economy so as to share opportunities and achieve win-win outcomes in openness. Strong wind tests the resilience of the grass, and fierce fire reveals true gold. As long as we step up to take our responsibilities and look out for each other, the giant ship of the BRICS will brave the shifting international tides and sail far and steady.
So China's president is very much expanding upon his vision of the multilateral world order that he talked about at the SCO summit and also at the military parade last week, which Kim Jong-un of North Korea made a rare visit. And now we're seeing President Xi has said that China is ready to enhance communication and close cooperation with North Korea for regional and world peace and development. And this comment is coming as marking the 77th anniversary of North Korea's founding. And at the same time, we also see China doubling down on non-U.S. markets as exports to the U.S. plunge. And it is pushing for ASEAN to sign this upgrade to the free trade agreement that was concluded. The negotiations for that were wrapped up earlier in May. So we see China really focusing on huge trading partners such as ASEAN, which to China is very important as it is China's largest trading partner, JP.
Fascinating. A lot of things said there, Elaine. But while that's what President Xi said, the Indian Prime Minister skipped this meeting. That's Narendra Modi, not at the virtual summit or the virtual meeting. What did you make of that, actually?
So leaders have skipped this BRICS summit before and sent other representatives instead. For example, Xi has recently sent Li Qiang, the premier, to attend an earlier BRICS summit. But Modi skipping, especially as India is set to assume the rotating BRICS chairmanship next year, does seem to show how India is walking this tightrope with its relations with the U.S. and with others like China. And but India did send its foreign minister to the BRICS virtual summit. Let's take a listen at what he said.
The world as a collective is seeking a stable and predictable environment for trade and investment. At the same time, it is imperative that economic practices are fair, transparent, and to everyone's benefit.
And what's notable is that this is after Modi showed that closeness with President Xi and Putin at the SCO summit in Tianjin last week. And he talked about improving ties and trust with these two countries. And Trump was recently also probably looking at the SCO summit and now saying that India and the U.S. have a special relationship, and that Trump said, "I will always be friends with Modi," to which Modi responded he fully reciprocates Trump's sentiments. But still, India is working to diversify its trading partners. It also has a free trade agreement with ASEAN, and the next round of review talks will be in October in Jakarta. So we'll see how well this multi-alignment approach that India has goes as it negotiates all these different trade pacts. JP?
A lot of interesting developments, and all of these currents circling around India also because of how important trade is going to be for them. Elaine, thank you so much for the latest on that recent BRICS summit convened by some of the nations as part of that group. India is looking to diversify partnerships, as Elaine mentioned, after the U.S. slapped 50% tariffs on exports from New Delhi last month. And as part of this push, India signed a landmark investment agreement with Israel aimed at promoting and protecting reciprocal investments. Israel says it is the first OECD country to strike such a deal with India. Israeli finance minister is in New Delhi for a 3-day visit and signed this agreement with his Indian counterpart. The agreement is expected to boost trade and investment flows.
The bilateral investment agreement that I signed today with Indian Minister of Finance gives a strong tailwind for private companies to come and invest in each other's economies.
And India is also moving closer to a free trade agreement, this time with Qatar, with terms expected to be finalized in early October. Trade Minister Piyush Goyal could visit Doha on October 6 to conclude this framework, with both countries earlier agreeing to double trade to about $28 billion within 5 years. Qatar has also pledged $10 billion in investments in India across infrastructure, technology, and food security. Alok Saigal is the president and head of Nuvama Private, who's here to talk to us about an emerging wealth corridor in Asia that happens to include the Gulf region, Singapore, and India, indeed. Alok, thank you so much for joining us today. Before we get into this growing wealth corridor that that's been coined and has been noted by many, a lot of this really centers on wealth management in India and how Indians are looking for more ways to manage their wealth. Exactly. Can you help us understand how big the wealth management industry in India is now, and how big it'll be in, say, the next 5 years?
Thank you for having me. So if you look at the last 4 years, the wealth management industry in India has actually grown to $1 trillion. And this was $250 billion 4 years ago. This is also in line with India's GDP growth. If you see, India's GDP has now increased to $4.1 trillion. So there is a true wealth effect that is happening. Obviously, the increased economic activity, affluence, and the overall wealth impact that we are seeing. So we are expecting this wealth management industry particularly to grow by 15 to 20% over the next 5 years. And by conservative estimates, in 5 years' time, this should be a true $1 trillion industry, doubling from here. There are 2-3 reasons why we say that. There is an increased sophistication, increased financialization in India. Earlier, India was, a very much two-asset class market, which was real estate and gold. Now, if you see, India has become sophisticated, a lot more products, alternative assets, global access. And therefore, a need for wealth managers has been emerging. And this trend especially changed post-COVID. So that is where we see the industry heading to.
Alok, help us understand what's driving the demand for wealth management. Is it the sudden emergence or the surge in high net worth individuals in India, as we've seen a lot more wealth built there? Or is this actually coming more from the mass affluent or the middle class? What are the specific growth drivers that's really driving all of this optimism and this growth that we're seeing in this sector?
Sure. So I'll tell you there are three to four specific factors. One is that there is a very large intergenerational wealth transfer that is happening in India. And that actually is bringing about a lot of activity in terms of stake sales, IPOs. The next generation is looking to professionally manage their company, make it a formal sort of enterprise rather than a family-run enterprise. And this is bringing in external investors, private equity, which is leading to a lot of liquidity events. So this is one big source of wealth creation. Second, if you see, India has also been a huge entrepreneurial hub, especially in the startup ecosystem. And that is, again, adding a lot of wealth effect. A lot of now Indian startups have become unicorns. India, in fact, today has closer to 150 plus unicorns. And a lot of the unicorns have now been listed over the last 2-3 years in the public markets. And people have seen large sizes and exits, and global players are investing in that. The other is obviously as the GDP grows, there is a clear wealth effect that is happening in India. And to very specifically answer your question, India is seeing impact in both specifics. Like, I'll give you one example. There is an Indian company, I'll not name that here, but it got listed on NASDAQ. Now, that listing itself created 80 millionaires in Bangalore, which is the IT hub, because all of them had ESOPs. And I'm not even talking about the founder or the promoter equity there. So these sort of events are increasing the wealth impact. So we are seeing the impact both at the top end of the segment and the mass affluent and HNI segment, the growth that is happening. I think the last part I would like to add is a lot more awareness. Indian markets have become a lot more sophisticated. If you go back as recent as 7-8 years, 10 years ago, you will see a data point that, India had only two asset classes: real estate, gold, and maybe fixed deposits. Today, the equity market has become very vibrant. Indian markets have a huge market capitalization. You have a lot more opportunities for people. Markets have become sophisticated. There is REITs, InvITs. These were words never heard of in India. There is structured products, alternative assets. All these have actually, and offshore access. So that is, again, something that has come up. One data point that I'd like to share with you, if you look at all the wealth reports in India, which tracks the rich and, the quality of the geographical spread of that rich list. So India had around 130 cities where, people above $100 million were spread out. Now that number is now closer to, sorry, I meant to say that, we were in 25 cities. Now that 25 cities from 2012 has become 130 cities. And that is something that is also showing the geographical spread of where the wealth dispersion has happened.
So it's not just the rich getting richer here, Alok, because we're also talking about newly affluent entrepreneurs who are looking for better ways to manage their newly developed wealth. What kind of products exactly, or new products, are they actually looking for to manage that wealth? And how does this wealth corridor that we've identified perhaps provide them access to those products or solutions that they're now looking for?
So, see, domestically, people are looking at now from earlier, as I mentioned, from just real estate and, gold or simple mutual funds. Now, people have moved to managed equities. People have moved to, alternative assets, which are actually giving them underlying ownership of, things like commercial real estate, underlying ownership of transmission and road assets. So India has become very sophisticated. India has built a very large market for real assets. And because India has always been a market which loves, the touch and feel. So real assets through, REITs, InvITs, pre-REIT, pre-InvIT, and, some of these things. Then one of the other things that has picked up a lot is, the credits ecosystem. India always had, credit coming through the banking channel. Now, the credit actually as alternative assets, as we are seeing globally, the credit as an asset class has become a very large asset class, in India, and that is the other part that we see. And then there is things like structured products and offshore. I'll also talk about the corridor that we are seeing. Now, if you look at the Indian diaspora, one is the Indian diaspora outside India, but the Indian businesses are also becoming very, very global. They have aspirations to have, one foot outside India, both in terms of their businesses, also in terms of diversification. Now, this is also a journey of each market, if you see. Now, typically, when you see, all markets in India, even though the market had become very sophisticated, all our investments are in a single asset class, which is the rupee. Now, as the market gets more and more sophisticated, people actually realize that they now need to move from one asset, single currency to multi-currency. And that multi-currency is something that, is again adding this, diversification that, is coming around. So Nuvama is actually looking to build this corridor. We've now have full-fledged licensed offices for wealth management, both in Dubai and Singapore. And we are seeing the two markets as very, very different. Singapore is, a very, very stable wealth management market with all the fully developed financial systems, very sophisticated. So a lot of the large family offices want the stability of Singapore to set up a family office there. And a lot of the regulations are also very friendly in terms of, taxation, etc. Dubai, again, very close to India, both, geographically, politically, and it is actually something that is very close to India now. And therefore, we are seeing, a lot of traction in the IFC specifically. And people are looking to, both for lifestyle, plus, looking to set up family offices there. So what we are trying to do as Nuvama is that we are building a corridor where Indians, when they are looking to set their family offices outside India, is specifically because Nuvama is a partner of choice in India. We want to continue their partner of choice outside India. The second is the ancillary benefit is that, both these geographies have a significant Indian diaspora. So people of Indian origins and non-resident Indians, they have never invested or they don't have a platform even today to have a full wealth management platform in terms of India access. And we being India specialists are saying that, we will offer you this full-fledged India platform. And I think that is something that is working for us. And we are seeing very good traction. And as we build this out, we are also hopeful that, we'll be able to offer this to the local population. But that is our, a future plan. But currently, the way we see it, there is enough and more opportunity in building this corridor right now.
Now, look, very quickly here, when you look at the framework itself, it's assumed at least that Dubai, Singapore, and even India are competing for wealth management, for family offices to be set up here. But this framework seems to suggest that it's more collaborative. What kind of solution is there, very quickly, that shows Indian wealth perhaps being serviced by both Singapore and Dubai and shows that there's more collaboration rather than competition?
So I'll tell you, I'll give you examples specific for both Dubai and Singapore. And India also has its own Gift City platform. So you rightly said that India has a Gift City platform, which allows access to, global markets. So that is where there is a slight bit of competition. But the fact is that a lot of Indian families already historically have had wealth outside India, and they also have economic interests outside India. They have exports to Southeast Asia, Middle East, Africa, Europe. Now, both these geographies become very, very useful jurisdictions to manage that cash flow and build that out. So Singapore specifically offers, I'll come to Singapore first. Singapore specifically offers two regulations under the family office structure, which is 13O and 13U, which are very, very friendly, which allows the Indian families to set up specific family offices entities. And then also there are the VCC structures. People find it very safe. And people are looking to actually diversify at least 20 to 25% of their wealth. So once they're set up in Singapore, then they're looking at, global asset allocation, which is, as much as, US equities, global bonds, Singapore bonds, or Asian bonds. And that is where the structure is putting that in place. Similarly for Dubai, Dubai offers actually a single family office structure in DIFC, which is extremely friendly and tax friendly from an India point of view. And then Dubai also has structures which are, linked to a foundation which people can set up to ring fence their assets. And again, in a single family office structure, once you're in a place like the IFC, you have access to the full global markets. So you have access to all the global products, global bonds, global private banks, and obviously the leverage that is available, including trading and structured notes. So what we are trying to say that once you're outside India through Nuvama, you actually have access to the full global platform, whether it is Singapore or Dubai. We as Nuvama are actually agnostic in terms of which geography people are looking to, participate in. But the fact is that we are seeing attraction from India in both these geographies because both historically have been close to India, have significant diaspora. So what also happens is that a lot of Indian families have their, friends, relatives already there. Children are looking at foreign education. So people are also looking at real estate and housing, which is also becoming a big lever for people to invest specifically in Dubai. It also becomes a gateway for Europe for exports in Africa. So that's how the overall picture looks at for us.
Alok Saigal from Nuvama Private will have to leave it there, but fascinating to see this developing wealth corridor that you guys have coined that's developing between India, Singapore, and Dubai, and we'll see if this continues to develop in such exciting fashion. Appreciate your insights. That's Alok Saigal from Nuvama Private. We'll be back in just about 2 minutes, but we'll cover more with regards to the Indonesian markets and also counting down to the Indian market open in about 25 minutes. If you're watching Inside India, don't go away. Welcome back. And while we're about 22 minutes away from the Indian market open, let's take a look at Indonesian markets today. And of course, this coming off the surprise resignation or the surprise relieving, that is, of longtime finance minister Sri Mulyani Indrawati of her duties. Some say that she was fired, although some reports actually in Indonesia indicate that she actually submitted a resignation twice since the concerning protests and riots that hit Indonesia 2 weeks ago over the pay packages and some of the perks given to lawmakers. Take a look at the Jakarta Composite, now down by about 0.9%. And a lot of concerns actually raised with regards to her successor, who they see might not carry the same reputational cachet in managing the fiscal balances and fiscal disciplines of Indonesia. We want to take a look at how bond markets in Indonesia are also reacting today. And if we can pull up the chart to show bond yields, there you go. A significant uptick, that is, with regards to 5-year and 10-year bond yields today, once again indicating that there is significant risk-off sentiment given the new uncertainty with with Sri Mulyani Nirwati being removed from her post as the longtime finance minister of Southeast Asia's largest economy. Meanwhile, we're also watching Japan because there's also political instability that continues in that country. Lin has the market reaction for this particular part of the world. Lin, walk us through what exactly is happening in Japan right now.
Hey, JP. Well, we've actually seen that when we look at the blue chips Nikkei 225, that it rallied to an all-time intraday high, although it has pared back. We are in the lunch break at the moment. There is other factors at play, particularly in terms of what we saw in the US. But as far as the domestic situation is concerned, this is at the top line level, potentially some of that positioning that we could get more expansionary fiscal policy to come, and that is net seen as a positive for Japanese stocks as well ahead. Early days, of course, and a lot will, I think, depend on what the heavyweights of the party, who they back. Ultimately, in the end, they've done away with factions, but there are still these sort of de facto factional leaders at play here. One of the favourites that the markets have been talking about a lot, Sane Takeichi. Now, the path forward for her is perhaps not as simple as people think, because in terms of the right side of the party, they have been weakened in the last couple of years off the back of a number of scandals. And in fact, the moderates within the party, they do not want her to become the Prime Minister. They are worried that she will take the party further to the right. But certainly, I think in the here and now, we're focused on two key things. The first, today, the election committee will tell us what is going to be the date of this contest. The expectation is that it will be around October the 4th. We are expecting the full spectrum leadership contest, much like what we saw last year as well. Those were some of the contenders on the board. And I think in the interim, in these weeks, of course, what will go to the wayside, or there's a high risk of that, is a lot of the policy making, whether it's in terms of the economic policy. Ishiba was talking about a package in terms of dealing with inflation and so forth. I guess the question is going to be, are we going to be able to get any of that, as the focus is really on the contest?
Another year, another prime minister in Japan, it seems, and we'll have to see who that person actually is. Lin, thank you so much for joining us today and helping us understand the latest with regards to the political uncertainty there. And coming up, the festive season is about to kick off in India. Which sectors will take advantage of the tax cuts this season? Well, we'll discuss this after a short break. Don't go away. You're watching Inside India. Heavy rains and flooding in India and Pakistan's Basmati belt are threatening output of the premium rice variety. Punjab and Haryana in India and Pakistan's Punjab province, which together grow over 80% of the world's Basmati, have been badly hit. Exporters say up to 20% of Pakistan's Basmati crop may be damaged, driving prices up by $50 a ton. In just 1 week, the industry had expected a bumper crop, but supplies may now fall short, pushing costs higher in the global markets. We are counting down to the market open in India in just about 15 minutes. And again, taking a look at how GIFT Nifty futures are forecasting that. We're still expecting gains from yesterday's close of 24,773. In fact, GIFT Nifty futures trading just about 200 points, about 180 points actually from yesterday's close. The Indian rupee, though, looking a little bit softer today at 87.97 against the US dollar. You can see there as the market develops and as we lead up to the market open, it continues to show signs of softness actually and weakening so far ahead of the Tuesday open. India's fuel demand is screeching to a halt as consumption hit an 11-month low in August. Data from India's oil ministry shows demand slipping by 3.8% month on month. Year on year, August consumption still rose by 2.6%. India's finance minister affirmed that New Delhi will continue to buy Russian oil despite punitive tariffs from the United States for its energy purchases from Moscow. Indian automakers are also banking on a festive boost this season after GST cuts on vehicles. The Tax Council last week slashed rates on small cars and two-wheelers to 18% from 28% and scrapped an extra levy on SUVs and bigger cars. The dealer's body, FADA, says the move will lift demand, though many buyers may hold off until the new rates take effect on September 22. Car sales rose nearly 3% in August, but top automakers including Maruti, Mahindra, Hyundai and Tata saw wholesale shipments dip nearly 9% as inventories built up. Stocks now averaging 56 days, well above the 21-day norm. But despite all these signs, there are still a lot of signs of optimism with regards to the GST's impact on the festive season. It's not just the automakers that seem to be the auto dealers that seem to be showing optimism, actually. To get a better gauge of how this has changed the consumption outlook, at least in picture out in India, we're joined by Kushal Bhatnagar, an associate partner at Red Seer Strategy Consultants, which is a firm that focuses and specializes on consumption trends and the consumer sector in India. Kushal, thank you so much for joining us today. Before we get into some of these sectors, I'm pretty sure that this was viewed also by you folks as being one of the more exciting things to happen in your space in recent years and perhaps led to many happy revisions. Can you talk to us about how different the forecasts are now for consumption in India and the festive season before and after these GST reforms were implemented?
For sure. I think definitely something that was being talked about even while we were preparing through the festive period forecast and when we were engaging with companies over the last 1 month or so. There was, of course, at some point, a lot of uncertainty about when this will be implemented. But I think with the clarity of the implementation, particularly around the September and the date has now come in from the ministry, I think things are a lot more clearer and the impact can be ascertained a lot more. So definitely a more welcome move by the overall industry. I think even before the festive period, there were signs of a positive festive all year round. I think with the repo rate cuts, with the income tax reforms, with some of the other indicators such as rural income as well as some macro indicators such as underwear volumes, right? So somewhere we were always gearing towards a strong festive even before the GST reform. Now with a clearer GST outlook, it's even more strengthened. So definitely a positive outlook per se. I think we closely as a company looked at how e-commerce as a sector will perform during festive. And I think when we look at those forecasts, those are like almost the best performance in the last 5 years or so is what we are expecting. So in terms of growth numbers, you have to put some numbers to this. It will be around a 20 to 25% of year-on-year growth versus last festive period, which is, like I said, almost the best in the last 5 years. So at least from an e-commerce perspective where we have a deeper quantitative view of how the performance would be, I think it definitely looks promising.
So is the e-commerce sector of India going to see a more significant upside or uptick from consumer spending during this festive season as compared to the traditional brick and mortars, for instance, especially given the fact that e-commerce has been a growing trend in India even before the GST reforms were introduced and even during the COVID-19 pandemic, if you go that far back even. Is this going to be the sector to watch versus, say, the traditional brick and mortars?
So definitely see e-commerce is driven by multiple factors, is on a different growth spree when compared to the offline retail, considering both unorganized and organized. And there are factors that are hinting towards that, right? I think when we are looking at e-commerce platforms traffic on some of the mini festive days, like the 15th August sale that happened some time back, or certain platforms have these mini festive events that happen once a day within a month. I think that there has been a decent uptick seen on e-commerce platform on those days already. That basically hints towards a decent festive demand that consumers have leading up to the main festive season that's out there, right? Secondly, when we also look at some of the, let's say, search queries on e-commerce platforms, on the type of deals the consumers are searching for, the type of products they are looking for, it definitely hints towards a significant pent-up demand that may be existing among consumers, and that may be just relayed out in the e-commerce festive period that's gonna be upcoming, right? So those were a few strong indicators why we believe the forecast will be such. In addition, I think, and you must have followed this, there are some of these unique e-commerce models that are picking up really fast in India. Now, this includes the likes of quick commerce, and also the likes of value commerce, which are serving different ends of the household pyramid in India. But then I think they have been growing at, let's say, even in the BAU period, expanding at a significant explosive pace, right? And so that momentum is going to be carried to the festive period as well. So when you put all of that together, it definitely hints towards a much stronger performance for e-commerce, hinged by both, I think, the pent-up demand of broader consumption trend that I just spoke about, and also the this emergence of new models which are actually growing at an explosive pace, and all of that will also aid into the forecast I just spoke about.
Now, this is interesting that you pointed out, Kushal, because it's not just important to note how strong the Indian consumer is in terms of confidently spending, but how they spend. And if it is indicated that e-commerce is really going to pick up by a huge clip during this festive season, driven in part by those GST reforms, is this a signal that perhaps the consumer trends and how Indians are spending is indeed changing more towards digital, more towards online? And could this mean actually some headwinds for the more traditional brick and mortars that we're seeing out there?
So I would say that if you look at the e-commerce penetration of India's retail market today, it is at a 7%. So almost, let's say, 7% of total retail products are purchased in terms of value are purchased online, right? In some form, right? So there is a significant headroom for e-commerce to penetrate further. Having said that, 93% is still served by offline retail, right? And there are interesting models within offline retail as well, which are doing equally well, right? So I think India as a market, when you look at the GDP per capita at this point, the consumption trajectory at this point, right, there's a significant headroom for the overall consumption pie itself or the retail pie itself to expand from here on. Of course, within that, the channel dynamics will change a bit when you compare against a market like China, wherein you have 30 to 40% e-commerce penetration. There's a clear headroom for e-commerce to grow further, but I won't call it a headwind per se, because I think looking at the pace of expansion of our GDP, consumption, and retail in general, I think the overall pie of retail itself is expanding decently fast. And of course, the organized models within that, whether it's organized offline or organized online, which we call as e-commerce, are likely to benefit a lot more because India traditionally has been a unorganized retail country, right? So almost 80% of retail consumption still happens through local mom and pop stores. So of course, that shift will happen toward in the favor of organized models, and that will continue to happen over the next few years. And e-commerce is one of the key beneficiaries of that particular shift.
Well, whether it be online or offline, it seems that the GST reforms are going to provide a significant boost during this festive season, Kushal, at least based on what many are expecting. But there are some concerns that because of the depth of the GST reforms and the savings that might be introduced, it might mean that there might be shallower discounts during this festive season, which is also very important for this particular period. What is Red Seer seeing and noticing about the possibility that discounts might not be as deep as they are because of the savings that the GST reforms will already introduce?
So the answer would definitely vary at a category level, right? If you look at the e-commerce festive pie, right? The top three categories in there are mobiles, appliances, and fashion. And then you have the other small ticket categories like beauty, grocery, home and furniture, so on and so forth, right? Now, for mobiles, the GST rates haven't changed. They remain at 18%, right? So there, the discounts will remain very typical to how they are with the festive season. And e-commerce is also a destination to purchase mobiles through the year during the festive. So that will continue to be the same. In case of appliances, definitely there has been a significant rate cut, which will automatically bring down the appliance volumes. Having said that, appliances, at least the large appliances, haven't had a great summer cycle in India. So there is some bit of an excess inventory that's there in the market, which brands will be pushing to release through the festive season, right? So our belief is that there won't be a significant holdback on the discounts in appliances, considering there is that existing inventory that's out there which will need to be released before the year ends. So considering that, I think the discounts are likely to stay broadly in the same range as they were planned in this category too. I think fashion is a small ticket category, so it doesn't get as much impacted by GST as what mobiles or appliances would have been. So there we believe things will remain very similar to what they were in a pre-GST period, right? So all in all, we believe that discounts will stay largely consistent. Yes, few brands here and there could look at holding back some of the additional value given to consumers given GST will anyways bring that down. But at a broad level, they are likely to stay in the similar range as the pre-GST plan.
Kushal, we just have about a minute to go now, but I just wanted to zero in on something in the report that indicated core festive categories that are worth watching out for. Can you help us understand what those core festive categories are that consumer watchers need to be aware of when they're looking at the impact of GST during this festive season?
I think, like I said, I think these three, mobiles, electronics and appliances, and fashion, at least from an e-commerce perspective, they contribute at least anywhere between 70 to 80% of the overall festive GMV. And hence, they actually determine the growth in these categories, actually determines how the overall festive performance for the market or a channel will be. Of course, there is a tail of categories which are growing much faster than these because these are more stable ones, but they will still continue to form the core pie and hence called the core ones.
Kushal, can you name any of these mobile brands that might be seeing more interest or upside than others leading up to the festive season?
So, see, there's definitely still significant uptick that iPhones see during the festive period in India because it is considered to be an aspirational brand across a majority of India, and that still continues to happen. And consumers actually hold off on their iPhone spends throughout the years and hold off some of their money or savings aside to purchase that during the festive period, particularly, right? So I think that's one brand that definitely picks up very well during this period, and that will continue to happen.
And Kushal, are there expectations that during this festive season we might see personal debt or credit card debt perhaps rising to try and meet these deals and perhaps take advantage of the lower GST impact, at least on these items?
So I didn't get that question completely.
Oh, just looking at credit card debt perhaps rising as people try to rush into the festive season to take advantage of these deals. Could we see personal debt actually rise to try and accommodate these, despite the fact that they're saving money from GST?
So I think a lot of if you just talk about e-commerce or even the organized retail, right? A lot of these offers are actually offered through credit card EMIs or credit card discount or certain bank partnerships that happened between some of these leading credit card providers and the platforms or the brands, right? So that continues to happen in festive period, and that will consistently be happening here. People may be saving, let's say, money to keep a decent corpus available in their bank account to pay off the festive bills, but to maximize the discount potential, I think a lot of the consumers will still continue to look at and maximize these credit card offers which are available out there. And credit penetration, as you would be aware, is anyways going further up in India. So, like I think every festive season, that debt is likely to go up because I think most leading players, whether it's offline retail or online retail, they will be partnering with these credit card providers to provide better deals. So that will continue to happen.
And about 14 days before the GST reforms do kick in, and we'll see exactly how that impacts this very important and exciting festive season out in India. Kushal Bhatnagar from Red Sea Strategy Consultancy, thank you for joining us today and helping provide more context with regards to the festive season and GST's impact. Meantime, Vietnamese EV maker VinFast is expanding rapidly in India with competitive pricing and local production. Its Asia CEO, though, highlighted the policy in the country lags the speed with which companies move. Pham San Chao saying India's EV policy was notified after the firm began production, leaving VinFast for incentives despite investing since March 2024. EV makers like VinFast are racing to go global with a fast-growing market and rising demand. Chinese OEMs too are on the move, BYD eyeing India, while XPeng and GAC unveiling bold expansion plans at Munich's IAA Mobility Show.
The current growth of XPeng globally is faster than we would have expected. This year, we have entered around 60 countries, while 2 years ago, we only entered 3 to 5 countries. In the next 2 years, we'll launch a big variety of products, including purely electrification, longer cruise distances, higher level of autonomous driving. I believe this is the trend, and this trend will be intensified this year and in the following 2 years.
GAC was founded in 1997. In 1998, we first started partnering with Honda. In 2004, we had a joint venture with Toyota. Later, we established partnerships with Mitsubishi, Fiat, and others. So, through these experiences, we are fully aware and understand that for a foreign brand to enter a targeted market, it is necessary to take time to go through the localization process. In the future, we hope to accelerate the manufacturing localization. So, we can build up manufacturing capabilities in Europe for Europe to better serve the European market.
And Indian markets joined the trading day about 3 minutes ago. We will deep dive into the opening session after this short break. We're back in 2 minutes. Indian markets have come back are now trading out in India, and so far Nifty opened for the Nifty 50 this Tuesday up by about 1/3% to 24,860 points. Again, the optimism continues in a measured pace, but optimistic nonetheless for traders out in Mumbai. The Indian rupee, though, as you mentioned a while ago, continuing to soften as it has over the last hour, now at 87.99 against the U.S. dollar. It is off of those record week lows of 88.13, which it hit just about a week ago, but still we are seeing signs at least of a bit more softness, that is, for the local currency there. Let's look at some of the movers in the Indian markets today. Infosys, India's second largest IT services firm, is considering a share buyback. The board will review the proposal at a meeting on Thursday, with the company's last buyback conducted in 2022 when it approved 93 billion rupees to the program, paying up to 1,850 rupees per share. Investors will be watching to see if this move boosts shareholder value. Shares right now, though, trading about 3.1% on the back of the news of that possible share buyback, boosting sentiment around the tech firm's own stock at 1,477 rupees per share. The Nifty IT index is also getting a broader lift today, up by about 1.5%. 34,832 is where the Nifty IT currently sits. And again, it is still down about 16.9% from over the last 12 months, but definitely signs of an optimistic and perhaps encouraging comeback for the Nifty IT index. Again, doing quite well in one of the sectors to watch out for this Tuesday. We'll also see a new debutante hit the markets today. Amanta Healthcare set to list on the exchanges in just about half an hour. Its IPO is seeing a strong demand, subscribed over 82 times during the 3-day bidding. Non-institutional investors led the charge, bidding for nearly 210 times the shares reserved for them, while retail investors subscribed close to 55 times. Gray market trends suggest the shares could open at a premium. We'll be keeping close tabs on that action. A quick check now on gold hitting another record high, with investors piling into the precious metal amid growing expectations of a rate cut by the Federal Reserve this month. Currently, spot gold prices now up by about 0.25% at $3,645 a troy ounce. Now, that rate cut from the Fed could put pressure on the dollar and treasury yields, making non-yielding bullion more appealing. At the same time, stagflation concerns in the United States are mounting ahead of the central bank meeting, with CNBC's Steve Leisman taking a closer look.
Wall Street got the stag part of the stagflation equation with a weak jobs report on Friday, and the question this week is if they'll get the inflation part. An outsized increase in prices could give some members pause in cutting rates, perhaps not in September, but in the months beyond. Monday, the New York Fed showed inflation expectations pretty much stable, but at a relatively high rate above the Fed's 2% target. Tuesday brings benchmark payroll revisions that could show a substantial revision downward of U.S. job growth in the year ending in March of 2025. Producer price inflation on Wednesday and the all-important consumer price inflation report on Thursday. August core consumer inflation, which takes out food and energy, are forecast to come in at 3.1%, the same level as July. That should keep the Fed's preferred inflation indicator about a percentage point above the 2% target. Weak job growth expected to keep the Fed's focus on the employment side of its mandate. Most Fed officials anticipate tariffs will prove to be one-time price increases. Soft growth should put downward pressure on the non-tariff goods. But the concern among some Fed officials is service inflation, taking out housing. It rose in July for the 4th straight month, raising concerns about a wider inflation problem because services are not subject to tariffs. Some forecasters, however, do see a reversal of that service inflation coming in August. Futures market in the wake of the August jobs report are fully pricing in 3 consecutive rate cuts at the Fed's 3 remaining meetings this year, with even a 10% probability of a 50 basis point cut in September. While the September cut is probably not in doubt, barring a huge upside inflation surprise, Fed officials have suggested that they may need to stay somewhat restrictive as long as inflation remains above target. That could limit over time the amount of rate cuts this year unless inflation tops out and starts heading downward. Steve Leisman, CNBC Business News.
Now let's take one final check of Asian markets, shall we? And again, we are seeing the board is broadly green today, but there are signs of early gains in Japan starting to wane. After briefly crossing 44,000, it has seen intraday gains pare back significantly, perhaps indicative of the growing political uncertainty as Japan deals with the possible selection of a new prime minister after Shigeru Ishiba decided to submit his resignation. A bit mixed now in China, with the Shanghai Composite swinging back to the red side, down by about 0.3%. The Jakarta Composite also one of the notable laggards today after the surprise resignation or the surprise removal of longtime finance minister Sri Mulyani Indrawati, raising a lot of concerns there in Indonesia. Meanwhile, in the Nifty 50 today, still tracking and holding on to those gains of about 0.33% so far at 24,851 points. We will be continuing to monitor this because there is still a renewed optimism in India, but overall it is pretty optimistic, though there are signs, once again, as we mentioned, of that confidence being tested as the Tuesday session continues to progress, and we'll continue to monitor all of this as the session commences. Well, that's all the time we have today on Inside India. Keep watching CNBC, though, because Access Middle East is up next. Have a good day.